This conference will now be recorded.
Good afternoon, everyone. This is Kathy Neifeld with Agency One, and it is Friday, May 1st. I don't know how another month has now passed. We're now into May. And this is our third WebEx this week featuring COVID-19, the low interest rate environment, and today we're going to focus on the carrier. On Monday, we had the analyst. On Tuesday, we had the actuary, and today, we are thrilled to welcome Brooks Tingle, who is the president and CEO of John Hancock Insurance. And he is going to give us his perspective on what's happening in the industry and engage in some lively conversation with my partner, Gonzalo Garcia. So with that, I'm going to turn it over to Gonzalo and to Brooks. Thank you very much, guys. Gonzalo, take it away.
Thank you, Kathy. Brooks, welcome, and thank you for being with us. Today it is Friday, and I'm excited to get this week behind us. It's certainly the beginning of May, and here we are. I mean, another month has gone by. We're all still in our homes, and certainly there's an awful lot going on in the industry. So I'm hoping we can share a little remote fireside chat here. And talk about, I'm sure, a lot of things that you're thinking about and a lot of people on the phone call are thinking about. But as Kathy said, we had a great perspective from Colin Devine on Monday, past analyst for Citibank on the insurance industry. And then we spent some time talking, kind of doing a deeper dive into product on Wednesday. So this is really kind of, from your perspective, what is going on in the industry. And I think what I'd like to start is just kind of a general comment from you on, I get a lot of phone calls on, is the industry okay? Solvency, financial strength issues, reserving issues. Is this COVID-19 pandemic going to really have an impact on mortality? And then the interest rate environment is having a lot of pressure. So let's start kind of with those three, because I think that's kind of what everybody really wants to hear to start off with, and then we'll dig deeper into some other issues more related to John Hancock.
Yeah, sounds great. Thanks so much for having me, and what a great lineup you've had so far. I've known Colin all the way back to when Hancock demutualized, and no better person to get to comment on the industry as a whole. So commend you on your lineup, at least until today's choice. TBD on that one. But hey, it's great to be here with you. Thank you, Gonzalo. And it's just great. It's we were talking before the call began. The temptation is to say these are unprecedented times. Then you think about being a 157-year-old company and the world events that have happened. So institutionally, for a company like John Hancock, and it's true of much of the industry, not really unprecedented. World wars, Spanish flu, so many different events. Obviously, most of us remember well the events of 9/11, then of course the 2008 economic crisis. But having said all of that, it is quite an unprecedented time just for our generation, I think. One that we're so much better prepared for as an industry than even the financial crisis in 2008. The technology that's come along is evidenced by our discussion today. But for the fire, it seems like we're sitting right next to each other, really. And the workplace flexibility programs at Hancock, on any given day prior to this, only about 50 to 60% of our staff was actually in the office anyways. We were big promoters of workplace flexibility, work from home programs. So the move to working remotely was pretty seamless. No question, there are certain things that are a challenge, issuing physical policies and things like that, but by and large, pretty seamless. And I know that's true of the industry. Financial strength wise, it's when, there are sometimes things that we're not, it's not great about being an old conservative company. We talk about innovation a lot and things like that. And, but boy, it's great to be so strong financially coming into something like this. True of the industry for Hancock and our parent Manulife, just infinitely better prepared for this downturn than the 2008 financial crisis. The timing's a little bit tricky for me. We have our earnings call next week on Q1 results, so I'll have to be a little bit general about something.
I won't ask any specific forward-looking questions.
If you look at our, if you look at our ratios coming into this, even going into Q1 last published, so strong and so much more so than the financial crisis. So came into it really strong, and you'll see when we do our earnings results next week, continue to be very, very strong. So the industry is well prepared. The mortality, I want to preface my remarks about mortality. I almost hate talking about mortality in a clinical sort of business way, because I don't in any way want to minimize the pain. I'm sure everyone on this call knows people that have been affected by it. A buddy of mine was 49 years old, perfectly healthy, just got out of 32 days in ICU at MGH, one of the first patients there. New York Times actually just did a big story about him this past weekend. And many times during that, they told his wife he wasn't going to make it. And sure, we've all, lost people we know, elderly parents and things like that of friends. And so when I talk about mortality, please know that I'm not minimizing the pain and so forth of people that have been dealing with this. But purely in business terms, mortality really isn't a particular concern. And that's generally true of the industry. We do a lot of stress testing and things like that. Some interesting things about mortality: the average duration of a claim that we've seen so far is over 40 years. People that are presenting for claims with Hancock have on average been customers for over 40 years, which says something really positive about our business. That we have these wonderful long relationships. We're there for them. They could count on us. But it also says something to the average age of a claimant, and gives you a perspective on sort of how you might think about the financial consequences. These are older, typically smaller policies. Obviously, we have reinsurance support as well. And this is another part, I hate to even talk about it this way, but again, acknowledging the incredible pain so many people have endured from it. From a purely financial perspective, as a company that also has a large block of long-term care policies, a large block of in-force annuities, there is sort of some natural hedging there. When mortality spikes, we may see a bit of an increase in claims, but again, I hate to say it, but deaths have sort of an offsetting effect on other product lines. So long-winded way of saying that. Sorry.
Can I just touch on that one for a second, because it's interesting. First of all, Colin on Monday said that we're probably looking at a 2x normal flu season as it relates to mortality. And that would be 60 or so thousand deaths. I mean, we've blown past that. Now people are saying maybe 130,000. So is it in the models? And I'm not talking just about Hancock, but just kind of generally in the industry. Is it in the models to have a 4x influenza pandemic, as it relates to the normal flu? And is 130,000 deaths versus 60,000 versus some other number yet to be determined, is it going to put any undue pressure on the carriers? Or to your point about, natural hedging, longevity risk versus mortality risk versus morbidity risk, and you're kind of, if you're diversified, you've got natural hedges to protect your company.
Yeah, I'll be a little bit general, because this will be a specific topic during our earnings call, but I can tell you in general and speak for the industry that the types of stress tests that we perform are well in excess of the numbers that you're talking about, well in excess. And again, when you look at it, there's actually a phenomena going on. There's some debate among reinsurers and other academics as to what percentage of the deaths that are occurring from COVID would have occurred in the next year anyways. And it's not all of them, to be sure. There are some younger people that are getting this and having bad outcomes, but there is a very large percentage of deaths associated with COVID for people that would have passed away in the not too distant future anyways. And again, I hate to talk about this way, but I just do to make the point that the mortality part of this really isn't a concern. Again, we do the stress testing. We've modeled things far more extensive than what you hear in terms of the estimates, and even multiples of those estimates. The bigger concern, not nothing that will disrupt the industry.
We lost. I think we lost you, Brooks.
I'm here.
Okay, there you are.
Sorry.
Now I got you. Yeah.
The bigger concern, frankly, and I don't mean to shift off mortality, but the bigger concern really for the industry, and it's not a dire concern, but the more significant impact, honestly, are the broader economic conditions that arise from it. The interest rates. I remember sitting around a couple of months ago when the 10-year Treasury hit 0.8, and we thought, my gosh, this is like who could imagine that 3 days later is 0.5, and that's probably I would say where most executives at most insurance companies are spending a lot more time thinking about economic consideration, the economic environment more than mortality.
Yep. So I just want to kind of do a quick wrap on the mortality thing, because what I'm, 157 years, Manulife, John Hancock, you've kind of addressed some of the mortality issues, some of the hedging issues around other lines of business that kind of balance themselves out. And again, not trying to be too cold about the mortality issue, but we've been here before. The industry is, strong. We've got great balance sheets. We've got lots of reserves. This has been stress tested. So, the whole concern that I keep getting phone calls, from advisors and from their clients, and I'm sure they're hearing this from their clients quite a bit as well, is, look, let's not worry too much about the morbidity issues as a result of COVID. And now you're getting into some of maybe the bigger challenge that needs to be managed is the interest rate and the economic environment that may play out over the next months or even years, relative to how you guys are pricing product, pricing other things, and running the company. Is that just a fair wrap up on the mortality thing?
It is. The only other thing I'd add to wrap up when you talk about hedges on mortality, interesting things are happening. One of the leading causes of death now are accidents.
Yeah.
Overall in society, I think it's like
people aren't driving.
I was talking to one of our largest reinsurers. Their third leading cause of death, day in and day out, prior to this, were accidents. If you think about an insured population, accidents have gone to nil. So there are all these sort of interesting offsetting things going on in mortality, but very fair to say that mortality is not a meaningful concern for the industry.
That's great. That's great to hear. So in the world of the economic environment, and you started talking about low interest rates. I mean that's and we've heard this, right? We heard this on Wednesday. We heard this on Monday, and as you guys are going through your thinking on where are you going forward. I mean, there's been a lot of things that you guys have been doing internally relative to, how are sales being driven? What kind of cases are you seeing? Are you seeing a spike in transactions? We certainly have. I mean, there's a lot more policies coming in, a lot of it term, a lot of it automated underwriting, a lot of e-transactions. I mean, how are you guys gearing up to find efficiencies in the market and see what's going on as you move forward?
Yeah, those are great points, and the change has been pretty profound. I think in a lot of ways, acceleration of digital capabilities. The industry has been becoming more digital. Carriers with the express track underwriting programs, e-policy delivery, everything that was sort of happening at a certain pace has just been wildly accelerated. Prior to this, I think we had just under 40% of policies being delivered electronically. Today, 100% are being delivered electronically. Our express track solution in underwriting in Q4, 10% of all cases submitted went through express track. Past few weeks, that's been close to 40% of cases coming through there. So, so we've been fortunate. Our overall sales have held up pretty well through Q1 and even through April. Volumes are very interesting. Volumes, like new submissions coming in, are actually up some. But as you suggest, Gonzalo, within that, quite a dramatic reshaping of the contours of those submissions. Permanent applications are down about 20%, with most of that drop, as you would expect. You guys you're living this. Older ages, higher face amounts. But then like a 60 or 70% increase in term, generally younger, generally lower face, but not exclusively. So you net those together in a nice uptick in volumes, but very sort of different complexion. I'm really hoping, and you guys would know better than I, at the higher end of the market, I don't see those needs going away. I don't see this changing that. There might be some changed financial circumstances, but the stock market's back pretty well at that end of the market. So, I think there's no question you'll see carriers and you will all experience, a challenge in sales. Our sales, this month, for example, or April, were actually pretty good, to be honest with you, being non-specific, but But there'll be a couple months here just where, again, we all know the facts of life. Term just carries lower premiums, younger people term lower premiums. So,
Yep.
so while the volumes are holding up, there'll be a tough couple months, I think, sales wise. But my instincts tell me we're going to probably be looking at a pretty good Q3 and maybe just a really good Q4, because all of those cases that sort of aren't happening now shouldn't go away.
Right.
But
It's like pent up demand. It'll be kind of like everything will come at once.
right. Exactly. So, but I think, I always try to find the silver lining in these challenging times. And again, a lot of thinking about digital capabilities. I've seen in like some of the wirehouses and things where they would never have considered electronic processes around suitability or something, and openness born of necessity, I guess. And I think some of those things probably won't go back. Like once you say, hey, it's okay if this policy was delivered electronically, if we do suitability electronically, or hey, that express track thing worked pretty well. I'm not sure it'll stay at these levels, but I think we won't go back either, I don't think fully.
Yeah, so that's a great point, and I've asked that question a bunch of times. Is the genie out of the bottle and we can't put it back in? And I got to tell you, I mean, one of the things that we've always loved about Hancock is, Susan Galili runs arguably one of the best, if not the best, underwriting department in the industry, and she has really taken ownership of this crisis in trying to find ways to create flexible underwriting processes. So, it's not waiving exams, it's not suppressing requirements, it's just finding other ways to get there. And again, in the context of, is the genie out of the bottle and is this the new normal? Where do you, and you've been very involved in operations and vitality and other studies and other tech issues and stuff over your career. Where do you see this going? I mean, is it the new normal, or are we going to kind of go back to our old ways after a little while, or is underwriting and processing new business fundamentally changing and there's no going back?
Yeah, it's a great question. I think there's no question that it's going to create an acceleration of things that would have happened anyways, but over a much longer period of time. Underwriting, I felt for a long time that our underwriting processes are just ridiculous in the modern digital era. And we've been experimenting with a lot of things, use of electronic health records. I've always maintained, by the way, that I think underwriting innovation.
Yep, lost you again. I don't know if the mic. There you go. I think you're back. Nope.
It tends to be older, wealthier people. And they're seeing their doctor say a robust electronic health record. So all the things that we were doing in terms of can we use an electronic health record instead of a paramed or another exam, the things we put clients through, I don't think they'll be turning back on those. And we were very fortunate. Susan enjoys such a strong reputation with the reinsurers. We were able to come out with some underwriting guidelines through this that we feel very comfortable with.
Yeah.
One of the unfortunate things, I shouldn't call it unfortunate, I don't know what the right term is. Forgive me if I use the wrong words about mortality, but if you look at who's actually impacted by this, it's a lot of the, one of the reasons we haven't seen as many claims as the numbers of deaths would suggest. A lot of the deaths are occurring in the uninsured population. Unfortunately, unfortunate about the total number of deaths. But and it's kind of a sad thing about society, but a lot of the deaths are coming in the uninsured population. So, Susan and we enjoy the kind of reputation with the reinsurers where, frankly, we could do some things that maybe others couldn't in terms of relying on health records rather than current parameds. And I think we're going to be very reluctant as an industry to go back to some of the old requirements that just, when you realize you can get by with something easier for the customer, easier for you guys as advisors, why go back to it? So it won't be overnight, but I think this.
Yeah, you guys, I'm sorry to interrupt you, Brooks. I mean, you guys had a really cool press release just the other day with mentioning Claretto. I mean, can you speak a little bit to that? Because I think that's kind of, really market changing in a lot of ways.
Yeah, it's one of a number of partnerships we're forming to really try to make and it's as simple as trying to make the process easier, right? And I think the simple way to make it easier, most of us, I'm sure on this call, have access to our own electronic health records through an app, through our doctor or what have you. And we've done a lot of consumer research. about whether consumers would be willing to share access to their electronic health record if it meant a completely different buying process for something like life insurance, and the significant majority are willing to. And if we can just in a click give the customer an opportunity to say, yeah, I'm willing to share my electronic health record with you and get a price right back. So those partnerships are mostly around getting access to electronic health records, which should take, there's no reason these underwriting processes that take several weeks shouldn't be down to several minutes in time. And that's really across the whole market.
Yeah, and you guys have been leaders in that, and it's just, you know, the industry has been talking about this and getting ready for this, and all of a sudden this thing hit, and boom, here we are. I mean, it just happened so fast, and it's almost like, you know, maybe that's one of the positives that'll come out of this. We'll finally be able to run our businesses and get insurance out to market in a way that's never been done before. So I'm super bullish on the fact that, you know, maybe something good has come out of this disaster, and that we can move forward in a way, but also give you guys the information and the things that you need to put, you know, judicious risk on your books.
Yeah, I can tell you as a company, you know, rather than pulling back on spending and investments, our CEO and Manulife, Roy Agori, actually has given us more money over the past few weeks to say, accelerate as fast as you can these digital solutions. You see it in a partnership like the one with Colorado, but go all in on these digital solutions. So I think it's going to accelerate by a number of years where the industry was going, but in our usual way, it would have taken years. So that is a silver lining.
Yeah. Let's do a quick shift. And again, there's some redundancies here from the previous conversations that we've had, but I want to talk a little bit, and maybe specific to John Hancock, you know, given the environment, product pricing and availability. I mean, there's been a lot of changes in product and stuff. I know that some companies have gotten out of long duration term. Some people have gotten into long duration term. You know, where do you guys see long duration? You've been out of the GUL space for quite a while now, but your 20 and 30-year term products, I mean, do you see any impact on those long durations? What are you seeing, say, on caps for IUL? You guys have a pretty robust IUL product. You just had a rate reduction in your flagship protection UL product. That has a very unique, you know, portfolio that's backing that product. So I just want to talk about product generally and give you an opportunity to tell us what you guys are thinking at Hancock.
Yeah, we went through a lot of pain during the 2008 financial crisis as it related to our product portfolio. And actually, it stands us much better now, because we haven't been, you know, our portfolio isn't dominated by lifetime guarantees, long duration term. We've tried to really offer compelling value with strong guarantees, not lifetime, but strong, you know, at or beyond life expectancy for sure, married with, you know, cash and price. I mean, you know the story. And because of that, we don't really have to make, you know, we haven't had to take dramatic moves. We did, we're not immune. The economic conditions, at least as it relates to interest rates, are so extreme. You know, we did have to take a crediting rate action on protection UL, which is painful because we had very few of those. You referenced our investment strategy there, you know, the alternative long duration investments and so forth, and served us very well. We believe in it very strongly, continues to serve us well. So, you know, in no way is anything shifting strategy wise there. It frankly pained me to have to make two changes. If you look at the history of that product, we've barely changed the crediting. And
been very consistent. Yeah.
One of the most painful things I've had to do as a leader was make that crediting rate change. But the economic conditions were just so extreme that we did. But with the actions that we've taken, we were in really good shape. I mean, it's not like we said, oh, we'll do a little bit and hope things get better. You know, we're comfortable with where we are. People should not expect any other dramatic changes in our portfolio. We've done what we needed to do to sort of reflect this newness that we're facing. So never easy to make those changes, but we do it thoughtfully, and the portfolio is in good shape. We're not really facing, as we sit here today, having made those changes, we're not facing pressure relative to our portfolio.
And do you see any you've been very innovative, and you and specifically, I mean, you were behind the whole Vitality launch, and you and I have talked about your Aspire program for people living with diabetes. I mean, you continue to innovate and bring value to these products. So, what's new on the horizon? I mean, I know you guys always want to talk about Vitality and certainly Aspire. This is love to hear what your perspective on those programs are, but also, what other innovation are you kind of thinking about in terms of product?
Yeah, I mean, I think, again, you think about positives that'll come out of this. And I know I do talk about Vitality and Aspire a lot. Trust me, I don't get paid anymore if we sell Vitality or something else.
Yeah.
I just honestly believe that, in the modern digital era, we need to offer customer solutions that are engaging and offer living value, not just death value and all that. But I actually think we're going to, in terms of, again, I hate to keep talking about good news coming out of this because it's represented so much pain for so many, but
yeah.
there are going to be some real tailwinds for our industry here. We're already seeing it in sort of consumer demand for life insurance. And Hancock, we're very excited about where we're positioned. You think about what is going to be on people's minds. Our own mortality always comes to mind during these events.
Yep.
What if I get this? Is my family going to be okay? So we're seeing higher demand in life insurance already. I don't think that's going to go away. The second one is people are going to be, I know, believe me, I am a lot more thoughtful about sort of your baseline health.
Yeah.
Because if you follow, and you don't have to be an actuary or something to see what's going on in terms of outcomes from the virus based on your health when you got it. And people, I think, are going to be a lot more thoughtful. I know I'm thinking, geez, if next time something like this comes around, I'll dodge this one if I have to hide here for another year. But next time this comes around, I want to be, in fighting shape so that my prospects are best dealing with this. The third thing, telemedicine.
Yeah.
You mentioned Aspire, which is our solution for people living with diabetes. That has a strong telemedicine component where people living with diabetes can connect with a virtual endocrinologist or whatever, or FaceTime with them. I think that's going to be big. I've had many friends that have done, video sessions with their doctor, and they're like, why did I used to fight my way into the city and pay for parking to have a conversation with my doctor? I mean, certain doctor visits, you need to be there in person, but many, you don't. We could have a conversation like this, right?
Sure.
So all of those things we've done a lot of consumer research throughout this, and all of those are sort of mega trends, if you will, that our industry can capitalize on. And we think, Vitality and things like that will be even more relevant as you look at health outcomes, virus outcomes based on your health going into it.
Well, and when Aspire was launched, I said, okay, maybe this is the first of a number of diseases that are going to be treated this way at the insurance company level. I mean, I can't imagine that there will be other diseases. It will not be people living with diabetes. It'll be people living with hypertension or people living with whatever. Do you see the market moving that way? Are you guys, again, not to put you in a position to do forward-looking statements, but do you see more innovation coming in that area?
I definitely do. It's tricky because oftentimes they're comorbidities, right? There aren't a lot of people that are just hypertensive, or a lot of people that are just struggling with weight or whatever you used to. So it's a little tricky to think of a product for each one of those when they overlap. Vitality is sort of a good catch-all, but there will be others like Aspire for people with diabetes, and we will have more innovation. I can't say a lot about it, but I can assure you in the coming not too many months, you'll be seeing other exciting announcements from us.
That's great.
Broadly about partnerships and product enhancements.
We're looking forward to that. Brooks, we've got like a minute left. We're right at the top of the 30 minutes here. Just kind of a final question or comment from you. I mean, from the position that you're in running one of the largest and one of the oldest insurance companies in the country, relative to our industry, what would you say to consumers, advisors, BGAs, distributors, and other carriers as to whether, what we're going through now, is this an opportunity? Is it a challenge? And kind of how do you see the future for life insurance? Sure.
Two quick things. In terms of talking to consumers, I would say don't procrastinate. I saw it during 9/11 and it was heartbreaking. We had multiple calls, multiple circumstances where people had applied for life insurance with us, gone through underwriting, the policy was issued, but not paid for, and they died on 9/11. And the worst calls I've ever had in my career were from I'll never forget, a spouse that ended up talking to me and said, please tell me my husband, had coverage, because I know he was buying life insurance from you and they hadn't paid for the premium. And we've had a situation with COVID already. It was a doctor, unfortunately, who had gone through underwriting, universal life policy, gone through underwriting, done all the planning, gone through underwriting, all the heavy lifting, but the policy hadn't gone into effect and he died of COVID. So the thing, I would just use this as a call to action with consumers to say, if you think you need life insurance, if it's important enough to start, finish it, because it's heartbreaking to see people die without the protection they need. More generally, as an industry, as a company, and for all of you, that, again, not to sound crass about it, but like day 3 of this, once we realized our employees were safe, the business was running, we were paying claims, we said, opportunity, got to approach this as an opportunity. And there's real opportunity here. I think consumer mindsets are going to be where we are. When I say we, I mean you and I, all of us together. You bring this to life, for carriers. Consumers are going to want our services. They are. There's going to be a cohort that's going to have a hard time paying for them a little bit till they get their jobs back. But for most of the market, our solutions are going to be top of mind. And we think at Hancock, we've got some, for the reasons I mentioned, will be even more top of mind. But got to look at this as opportunity. Digitization, more digital solutions. You guys push us as carriers. Some cases we'll be pushing folks in the distribution value stream to adopt digital. Digital's here to stay. But we're going to be, again, I don't mean to make light of where we are, but I think there's more opportunity here than challenge.
Well, Brooks, I can't thank you enough for your time and sharing your thoughts with us. I mean, our partnership with John Hancock has been incredible for 20 plus years. Thanks to you for being on the call and sharing your thoughts with us, and have a great weekend. I would like to say to everybody else on the call, please have a great weekend and be safe. And Kathy, back to you.
Thank you, Gonzalo, and thank you, Brooks. That was fascinating and informative, and we've had a huge audience. So again, thank you for your time and for your partnership with Agency One. Next week, we are going to pivot to let's sell something here. So we heard from an analyst, an actuary, and a CEO of a major life insurance carrier. But as Brooks said, this is the time to make sure that your clients are buying the coverage and protection that they need. Next week, we are going to have a 3-part series featuring linked benefit products, and we are going to be highlighting opportunities from Nationwide, Securian, and One America. So I hope that all of you will listen to our first call on Monday, which is going to feature Sean Britt from Nationwide, and Sean is the Director of Long-Term Care Initiatives. And we are going to, we promise that we will be delivering to you sales ideas that you can implement now with your clients. So the invitations will be going out later this afternoon. I hope that everybody has a healthy and a safe weekend, and everybody can get outside a little bit. I know I certainly need to get outside this weekend. So stay safe. Again, if anybody at Agency One can help you, please reach out to Gonzalo, myself, Ed Lesher, Dennis Bartos, or anybody, any part of your Agency One team. We're here to support you, and we look forward to speaking with you and hopefully hearing from you again on Monday. Have a great weekend, everybody. Thanks so much.
Thank you, Brooks. Thank you, Kathy. Bye-bye. Thanks.